and with me is Sonal. Today we're going to discuss a very interesting topic, that is smart beta investing. It's not something that we have discussed here before, but like I said, it's very interesting. What is smart beta? Well, we have this complete show plan to take you through exactly that. But just for starters, think of it as the upgraded version of the conventional index investing. Okay, so this is a rule-based active management of passive investing that aims at outperforming indices. I know that sounds complicated, and that's why we have a guest here with us to take us through it.
Oh yes, and to make things simpler, let's get in with Siddharth Srivastava, who's the head ETF Products and Fund Manager at Mirae Asset Investment Managers, to talk all about smart beta investing and explain that to us as well. Thank you so much for joining us today on Mutual Fund Corner, and that's exactly my first question. What is smart beta indexing strategy, and are there certain market cycles that it works better in?
So smart beta indexing is a strategy where stocks are selected as well as weighted in a portfolio based on factors such as size, quality, value, momentum, low volatility, etc. So here the selection is not based on free float market cap, which is, let's say, in the case of Nifty 50, but selection is based on these individual factors or multiple factors, and even the weighing in the portfolio is based on these factors. Now, all these factors individually tend to behave differently in different market cycles. They have their different objectives, and that is why depending on which factor you are targeting, your experience can be very different in a bull phase or in a bear phase of the market.
Okay, got that. Okay, so Siddharth, we know that this combines the best of both worlds. This is the big tagline, that it combines active and passive and puts it together. But take us through, how does this really work in the model? Because this is not something all of us are very familiar with.
Yeah, exactly. So basically, smart beta, as you said, combines the benefit of both active investment as well as passive investment. So these factors are factors which have worked really well historically in identifying stocks and generating alpha in the long run on the active side. So what smart beta indexing does is that it picks up these factors, selects stocks based on these factors, and then simply put it in a passive framework, which is method driven, transparent, and low cost. So for example, let's say someone is investing in Nifty 100 ETF. What is Nifty 100 ETF? Top 100 stocks are chosen based on full market cap of the company. Not someone who says that I don't want to invest in companies which are selected based on full market cap. I want to invest in a portfolio of quality companies. Now you can define quality in multiple ways, but let's say we define quality based on return on equity, low leverage, very consistent profitability, etc. And you pick companies better within the large cap space based on these factors identified as a quality factors. And not only you select companies, but you also weigh companies based on these factors. So it's a different way of creating a portfolio. Smart beta may sound very technical, but it's actually very simple. You are just simply using factors which have worked on the active side and trying to create a rule-based, transparent portfolio based on similar selection parameters.
Okay, so while we are also trying to understand more of what you're telling us, let's break it down to the simplest form. Who is this kind of strategy best suited to? The viewers who are watching us, they would want to know that, okay, can we go ahead and do something like that? Who would you recommend it to?
So first of all, as I mentioned earlier, each factor tends to behave differently in different market cycles. So for example, momentum behaves very well when there's a bull market, whereas low volatility factor and quality factor behaves well when market is in bear phase or when there is some turmoil in the market. So first of all, investors should understand how factors are behaving, and depending on the factor behavior and his objective, the investor should choose a certain factor. So for example, a Nifty 100, a large cap portfolio, can be okay for all the investors. but a Nifty 100 base low volatility smart beta index will work very differently and maybe suited for certain set of investors, whereas a Nifty 100 momentum based smart beta index or ETF will be suited to a completely different set of investors because of the fact that they behave very differently.
Okay, got that. So that is who, this could really be well suited for. But Siddharth, also run us through what these different kinds of smart beta factors really are and what does the performance for these look like? Because I'm sure this also varies with the market cycle, right?
Absolutely. So let's think which factors we all know of. And again, as I mentioned, that smart beta is seems very complicated, but it's a very simple concept. So if you think the factors which are typically known, which works differently than the first, there is let's say a growth based factor where you identify companies who are showing very good uh, earnings growth. Then you have value, where companies are in a way trading at discount based on PE, PB, etc. Then you have factors like quality, as I have explained earlier. Then dividend, equal weighing, low volatility, etc. And as the name suggests, each of these factors target a different return and risk profile. And this can be understood from the name itself. For example, momentum. Here the stocks are chosen based on the fact that which have performed well in last 3 months, 6 months, or 1 year period. So you are betting on stocks which have performed well recently. So your portfolio will consist of stocks which are doing well, but then also it can, if markets turn around, it can perform uh, poorly also. Quality, as name suggests, you're picking companies based on good return on equity or return on assets, very low leverage and profit stability. Low volatility, on the other hand, you're picking up companies based on stocks which have been more stable across market cycle, which means that they have shown lower standard deviation or lower drawdowns, etc. So each of these factors, as I mentioned, is very different, and again, based on what the investor intent is, they should choose the factor or the product which is tracking those factors accordingly.
Siddharth, a slightly different question on this one. You spoke about how it is more suited for investors who know the markets really well versus a new entrant. In that case, is the churn in such investing cycles higher because you said it is as per the market cycle or as per different factors? So just to follow up on that.
Yeah, so again, it is probably for more evolved investor, if I can use that word. For example, a large cap portfolio typically is a core allocation, and the intent is to basically get the returns associated with large cap segment of the market. But in smart beta, the intent can be very different. The beauty of smart beta product is that each factor is used for different purpose. A portfolio which is created based on a dividend factor simply tries to achieve higher dividend yield for the investor. So, and same is the case with, let's say, low vol, which I explained earlier, or a equal weighing strategy. So, for example, if I am a risk averse investor, I can invest in a product which is based on, let's say, low volatility, or where the portfolio is created based on quality factors, and these factors have tend to perform well in the long run, and I can stay invested uh, for a long period in time. But let's say if I want to invest in a momentum based product, what is my intention? Do I simply want to invest in a bull phase of the market, and when markets are performing well, I invest in this strategy, in this product, and as soon as there is a turnaround or market starts performing poorly, I exit? And this is one case which has been observed with momentum or alpha based investing, that people are typically invested for a shorter duration. Also, one very important thing which people should understand while investing in a smart beta product is the market timing. There are factors, as I explained which works in a very cyclical manner. Momentum and value comes to my mind. So it is important to know that and understand that you are entering into these product at the right time. If you are entering at the peak, there are chances that for coming years you may end up underperforming the market. So just because the name is smart, it does not mean it will behave smartly at all times. It can also underperform the market. The name smart suggests that it is simply created to cater to different audience, different intent, different objective. And based on those objective, the investment can also be short term in nature or a long term in nature, depending on which factor you are using to invest.
Okay, I like that. Just because it's smart doesn't mean that it's going to be smart all the time. You also have to be smart and, time this a little bit. But Siddharth, speaking of that, since you have to time it, you have to assess your own risk return kind of profile, what you're looking at. How should an investor go about determining which smart beta strategy is suitable for their investment goals? Because this can be a bit of an intimidating task.
Yeah, absolutely. That is completely understandable that this is not as simple as products like Nifty 50 or Nifty 100, which are rightly known as plain vanilla products because there are no such complicated rule-based selection take place. But I think smart beta is very good for evolved investors, right? So there are certain factors or rather certain things which investors should keep in mind. First, as I have mentioned multiple times, what is the behavior of a certain factor, and is that behavior which I am seeking? If I am a risk averse investor, I should, for example, stick to dividend based smart beta or a low vol based smart beta product or a quality based smart beta product. And I should not think about momentum based smart beta product because it tends to have significant drawdowns also or significant underperformance also. But if I am a risk taking investor and I want to invest a smaller quantum in a very risky product, want to get that alpha when markets are doing well, then probably a momentum based product is suited for me and I can invest. Second thing which investors should know is that these factors, the portfolio typically is tilted towards certain sectors. For example, quality has lower weightage towards bank, it has higher weightage towards consumer durables, IT, etc. And same is the case with low volatility. And third, which investors should note, is that what is my current portfolio looking like? Am I, let's say, biased toward a certain factor, so I can invest in a different factor, which just give me a sort of a portfolio completeness. For example, if a investor has higher exposure towards small cap or mid cap, and he feels that overall volatility of his portfolio is on the higher side, he can invest in a Nifty 100 low vol 30 product so as to ensure that there's one portion of his portfolio which is less volatile, and hence the overall volatility of his portfolio is on the lower side. And lastly, as I mentioned, market timing is important. If you're investing for a long term, we are lucky to be in India, which is from a market performance point of view will uh, give positive returns in the long run. So I think that risk of significant underperformance or negative performance is taken care of in the long run. But still, investors should understand that if you're entering in certain smart beta products like value or momentum when they are at the peak, then you may see an underperformance for some time. If you want to be risk averse, if you want to invest for uh, a long time, then probably you should start with a low volatility or a quality based.
Okay, we take that point, Siddharth. It's an interesting discussion, but we'll slip into a quick break, and on the other side, we'll continue our discussion with Siddharth Srivastava on smart beta funds and investing as well. Stay tuned. Welcome back. You're still tuned into MF Corner, and we still have with us Siddharth Srivastava. We are discussing everything about smart beta investing. Siddharth, I did ask you about the churn. So, is there a minimum investment period you should get in with? What's the time horizon looking like here?
So, as I said, that typically depends on your goals and objective. If you are, let's say, investing in a momentum-based strategy, your goal can be short-term in nature. You're simply trying to cash market in the bull run, and you may want to invest just for a 6 month or an year period, and simply want to exit when there's a turn in the market cycle, right? But typically, if you're investing in a product like a low volatility or a quality or a value, you want to see the entire market cycle, and that is typically around 5 years. So you're looking at a long-term horizon. And what we have seen from historical data is that there are factors like quality, low volatility, etc., which tends to outperform the the benchmarks like Nifty 50, Nifty 100 over a period of 5 to 7 years. So I think typically, unless until you are trying to time the market using factors like momentum, it is probably prudent to stay invested for around 5 years to get that alpha from a smart beta product.
Okay, so maybe 5 years is a good period to at least have that kind of horizon in mind before you get in. Siddharth, but with, any kind of investing, same here, there are risks, right? And you did briefly mention some of them, the likes of concentration risk or, just the kind of cyclicality that we can see in the market as well. But take us through everything that we should look at in terms of risk, and how should investors try to mitigate these as well?
Yes, absolutely. I'm like, when people invest in smart beta, as I mentioned, people think that it's a very smart strategy and there will be no downturn or underperformance, but that is not the case. Each and every strategy can underperform. There's no strategy which works all the time, and that is true with smart beta products also. There are multiple risks associated. First one is, as I mentioned, that typically these smart beta products are skewed towards certain sectors. Product like low volatility or a quality based smart beta product we have seen being skewed towards sectors like IT, consumer, etc. Second is, as I mentioned, cyclicality. That certain smart beta products tend to behave better in different cycles, and that is why you may have a period of underperformance. For example, if you look, momentum has worked in the bull run, whereas low volatility has worked relatively better when markets have not performed better. Value, on the other hand, has performed well when there is a broader economic recovery in the market, and you have seen value doing well after COVID, and value doing well after global financial crisis. And then also you have seen equal weighted indices performing well when there is a broader market rally, not a concentrated rally, but a broader market rally. So as I'm mentioning, you are seeing that different factors are performing better in different market cycles. So that is one risk also, because if you enter at the wrong time, you may see the particular strategy underperform for a reasonable amount of time. Now, these risks cannot be completely mitigated, but they can be sorts of reduced by investing in more than one smart beta strategy. So you can invest in, let's say, a momentum, but correspondingly in a low volatility based fund also. So that's how you are investing in a factor which works in the bull market and another factor which works in a bear market. And then also you have to see whether you are, from a portfolio allocation point of view, investing in a complementary portfolio. For example, if your existing portfolio is skewed towards, let's say, BFSI, investing in a quality based product or a low vol based product which has lesser allocation to banks, etc., may work in your favor. So you have to think from a diversification point of view if you want to obviously mitigate the risk associated with smart beta products.
Okay, so while we are talking about the risk associated and what are the factors when one is looking at investing in a certain way, what are the smart beta funds available right now? Say someone has to pick one, which one would you recommend?
I think we all will be spoiled for options. There are so many smart beta products right now. We have seen, I think the kind of uh, products which are coming out on the passive side. I think smart beta is also not shied away from growth in the number of schemes currently available. So there are 21 ETFs which are currently there in the market with an overall asset under management of around 2,600 crores. There are 22 index funds in the market with asset management of around 4,500 crores. So you have almost 43 smart beta products on the ETF and index fund side with an aggregate AUM of roughly around, let's say, 7,000 crores. These products are based on low volatility, equal weight, quality, value, momentum, etc. So you have a whole plethora of options which are available for the investor to choose from, and I think yes, now you have reasonable amount of track record also of the funds also and of the underlying indexes also for investor to see, analyze, and invest in the right product. And also interestingly, not only just single factor based products in India, now you have multiple factor based products. So we have product which is based on low volatility plus momentum combined, which is choosing stock which are not only less volatile but giving reasonable returns also. So I think product wise evolution is a bit more. Now we have single factor based product as well as multi factor based products also. It's up to the investor to choose product which is more suitable to him or her.
All right, Siddharth, it's been a very useful chat and great to have you on the show to take us through this complete explainer on what smart beta really is, how you can design it, and how you should really get in, how much of your portfolio you should allocate as well. So thank you for joining us on this episode of MF Corner. With that, we're going to wind down on this special. But you guys stay tuned because closing bell is up next and they're here to take you through the final hour of trade.